everyone, it is Liana, ELA for Financial Information for Decision Making. I'm going to go over question 4.20, which is a week 1 question, just to hopefully make some sense for the people that don't understand it. So what I've done is here is 4.20. This is pulled straight from the e-text. This is a little working sheet I've made. Now this is not something that you complete within this unit. I've just created it just now to explain how to answer the above. Now before I get into this question, I quickly want to go over some accounting rules here that I've made. So this is pretty important. This is just very basic accounting rules that will become second nature as you go further in this unit. So up the top here, you will see that there's 5 different accounts we can have in accounting. We have revenue, expenses, asset, liability, and equity. Now each of these expenses have a nature. So when you think about accounting, we do double entry journals. So you'll always have a debit and you'll always have a credit. So again, you won't be doing journal entries exactly in this unit, but you kind of will be throughout worksheets, which you'll get familiar with as you go on. So it's really important to understand the nature of each transaction, because you know each account, because that's how you know whether to apply it as a credit or a debit. So revenue is a credit, expenses is a debit, asset is a debit, liability is a credit, equity is a credit. Now you notice in here, nature, I've also put in brackets increasing. So this is what applies when this account is increasing. So if we have money coming in, so an increase in revenue, we credit it to the revenue account. If it was decreasing, we would debit it. So for expenses, if it was increasing, we'd debit it. If it was decreasing, we would credit it. So we just flip it. It's the opposite nature if it is decreasing. What I've done down the side here is split up what accounts are in P&L and what accounts are in the balance sheet. So your P&L is just revenue and expenses. Your balance sheet is assets, liabilities, and equity. The formula down here, very important for the balance sheet, is assets equal liability plus equity. This is a great way to reconcile your balance sheet. They should equal on both sides. Okay, lastly, I just wanted to go over this here. So I've put in an event equals a transaction. So if we look at this example, all these events, A to I, all equal 1 or 2 transactions within your accounts. So in one transaction, there are 2 sides. So 2 sides to the story. So you'll always have a debit and a credit in a transaction. You'll never have a debit and debit or a credit and a credit. So it's really important to understand that to make sure that you're doing the correct entries. So this is what we call double-sided journal entries. Again, as I mentioned before, you won't actually be writing out journal entries, but you will in essence through the worksheet. So it's important to understand. In some transactions, which we'll see below, I think for G, you'll see we've got 4 lines here. So you actually have 2 transactions within the one event. All right, so firstly, before I jump into it, I just want to explain this worksheet here a bit. Obviously, we've got the question here. Account name is what we would call the account in, say, a balance sheet or a P&L. So, I mean, like you have an asset, but we've got so many different types of assets. So we've got multiple asset accounts. Then this is our account. So out of the 5 accounts we have here, which one is it? Movement. Is that account increasing or decreasing? That is super important for understanding the nature, as I mentioned before. And then lastly is your impact on the P&L. So we need to understand whether your P&L is going to have a positive impact or a negative impact. So is the profit going up or is it going down? And as mentioned up here, our accounts applicable is revenue and expenses only. So let's get into it. Let's start off. So A's already been answered for you, so I've put it down here, so we won't go through that in great detail, but I will talk over it. So before I start, we are doing these transactions for Humphrey Sports. It's a company, it's its own individual identity. J. Humphrey is the director, so that's important to know. That's why we're using capital down here. So J. Humphrey commenced business by injecting cash into her business. So we've got to think about the two things that are happening. We've got cash increase, so we're using cash at bank. Cash at bank's an asset. It's increasing, so debit nature. As you can see up here, asset, debit. J. Humphrey is putting money into the company, so that's actually capital is increasing. We've got capital, which is your equity, increasing, it's a credit. So you can see here, equity, credit. Impact on P&L, we've got no assets, revenue or expenses, then there's no impact on P&L. Wonderful. Let's get into part B, paid wages. So we're paying wages straight away. That means the money going out the door is going to be cash at bank. Cash at bank is an asset. And then the other thing is wages. Wages is an expense. So cash at bank and an asset, money going out the door, that means it's decreasing. So the nature of an asset is a debit, but we're flipping it because it is decreasing. Wages expense is increasing, which is debit nature. Do we have impact on P&L? Yes, we do. We've got the expense here. If we've got an expense and it's increasing, that means our overall profit is decreasing. Okay, so that one's fairly simple. So next we will go on to number C, which is sold goods on credit. So credit means we're not paying it, well, we're not receiving the money instantaneously. We're going to receive it in the future. So it is accounts receivable. This is an asset because we're going to be receiving something in the future. And the other side of it is revenue because we're making money, which is revenue. All right, so accounts receivable is increasing. It's an asset. Asset's a debit nature. Revenue, we're making money, so it's increasing. It's a credit nature. What's our impact to the P&L? We've got revenue, it's increasing, so that means our P&L is increasing. Okay, we've done number C. So number D, purchase goods for sale on credit. So this is very similar to the number C, but we're purchasing. So that means we're going to have to owe money in the future. So that means we flip it to accounts payable, which is a liability because that means that we owe something in the future. And then our other account is inventory because we're getting goods in. Inventory is an asset. So accounts payable is increasing because we obviously are owing something additional. So that means that is a credit. So inventory is increasing, asset, so we write increase here. An asset is debit nature, so it's a debit. Are we having any impact to the P&L? No, because we've got no revenue or expenses. So number E. Let's have a look at this one. Received an invoice for annual insurance on building and paid the account. So we're paying the account straight away. So we know straight away that is cash at bank. Cash at bank is an asset. Then we're paying off insurance, so that would be our expense name, so it's an expense. So a cash at bank, money going out the door, so that's decreasing. Opposite of a debit nature for an asset is a credit nature. Insurance is an expense. It is increasing because we're paying more of it, so that means it's a debit nature. So do we have an impact on the P&L? Yes, we do, because we've got an expense here. It's increasing, so that means our overall profit position is decreasing. All right. Number F. So I'll bring this over here. J. Humphrey withdrew an iPad from the business. So this is the director withdrawing an iPad from the business. So we know we probably wouldn't have an account called iPad. We would call it probably office equipment, which is an asset. So the other side of this is actually going to be capital because it's the director withdrawing it from the company. If it was an employee, it'd be a totally different situation. They'd probably pay for it, so it would probably be a sale. If they didn't pay for it, it'd probably be classed as stealing. But you can see kind of like if we look at transaction A, the director is pumping in cash, and that means capital is going up. Here, the director is taking away an asset, so capital is going to decrease. Okay, so equity is a credit nature, decrease, we flip it to a debit. Office equipment, it's an asset, it's also decreasing because the iPad is being taken out, that turns it into a credit. Do we have an impact on the P&L? No, we don't. So hopefully that one makes sense a bit more now. You really just need to think about it in terms of the director and what they're putting in to the business and what they're taking out. So it's going to, the other side is equity. Another easy way to think about it is here. So what's happening in both A and F is the assets increasing or decreasing. It's not attached to a liability. The other side's not a liability, so it has to be an equity. Okay? Let's go down to number G. We can see this here, sold inventory for cash. So you can see that this is a bit bigger. We've got two transactions within the one. So, did I skip one? No, I didn't. Sorry about that. So we've got two transactions within the one. So first we're going to record the revenue. So if sold inventory for cash, that means we've got cash coming in the door and we've got revenue. So cash is an asset, revenue is revenue. Cash is increasing, revenue is increasing too. Asset has a debit nature, revenue has a credit nature. So this is just one transaction. So maybe it might be easier to view it slightly separately. I might put a bottom border so you can kind of see the split between the two. Now, do we have an impact on the P&L? Yes, we do, because revenue is increasing here. So it is increasing our net overall profit position. So second part of this is we need to now look at the reduction of goods. So we're going to have inventory, which is an asset, and then cost of goods sold, which is an expense, which is on your P&L. So your inventory is decreasing, and your cost of goods sold is increasing because the expense is going up. So then that means that this one is a debit nature, and this one is a credit nature. What impact is this going to have here on our P&L? It is going to be decreasing. Perfect, nearly there. Let's bring this across. So H, T Comery, is accounts receivable. So that means someone that owes us money paid an outstanding amount. So we're getting cash for our accounts receivable. So this is the other side of the transaction for number C. So it's not, it could be like the payment for this one here. So C and H kind of go together. You can see two sides of the story. So we've got accounts payable incurred, accounts receivable incurred, and then accounts receivable paid. So let's do it. We've got, as I'm saying, accounts receivable. And our other side is cash at bank because we've got money coming in the door. Cash at bank is an asset. Accounts receivable is an asset. Accounts receivable is decreasing. So that gives it a credit nature. Cash at bank is increasing because they paid it. So that's a debit nature. Do we have any impact on our P&L? No, we don't. We've got no revenues and expenses here. Okay, let's look at our last one here. Humphrey Sports paid accounts payable in full. So this is the second transaction to D. So it is paying, so we are paying off the accounts payable. So very similar to H. So accounts payable, which is a liability. Then our other side, because we're paying money, cash at bank, which is an asset. Liability is decreasing, which makes it a debit nature asset. Money going out the door is decreasing, which makes it a credit nature. Okay, do we have any impact to our P&L? No, we don't. So that's it. That's their answers. Hopefully that helps you make sense. As you can see, this little bit right here makes it super easy. We just need to know, is it increasing and decreasing, and we know whether we to do a debit or a credit. Hopefully that makes sense. If you have any questions, post below. Thank you. Bye.